Okay, welcome back everyone to another webinar in office hours. This month's topic is cryptocurrency. Happy St. Patrick's, everyone. I have a few jokes for us today. Bear with me. Why did the leprechaun start his own cryptocurrency? He wanted to mint his own luck. Okay. Why did the leprechaun prefer cryptocurrency to a pot of gold? It's more liquid. So those are our jokes. I hope you liked them. Here's our agenda today. First, we're just going to put crypto into context. There's a lot to it. This is a big topic. We're just going to touch on a few things today, certainly not deep dive into any particular aspects. We're going to talk about crypto wallets and custodians, scams associated with cryptocurrency, looking at crypto as an asset, and risks associated with cryptocurrency. Then we'll just summarize everything, and hopefully we've learned a few things along the way. So the first thing I think everyone should be aware of is the market cap of Bitcoin and cryptocurrency when compared to other things, other asset classes in the world. So this is a graphic from 2023 showing the market caps of different companies, precious metal, the gold and silver there in yellow. Bitcoin is there in green, and ETF spiders there in red, and the remaining blue is both American and foreign companies. One takeaway from this graph is that today's market cap, 1.65 trillion, is much larger than the 412 billion in this graph. So today's Bitcoin market cap moves it pretty significantly up this graph here between Apple and Microsoft. Certainly larger than silver, right? It's good to put it into context because it is still far smaller than gold. Bitcoin represents half the market cap of all cryptocurrency, roughly, and that all cryptocurrency makes their market cap larger than Apple. A little more context about Bitcoin and crypto generally. This is a graph comparing the top 5 cryptocurrencies. Bitcoin at the top, most popular. Its market cap there, 1.67 trillion. Ethereum, second most popular and highest market cap to 231 billion. This Tether is what's known as a stable coin. Its price rather, stays at $1, and that's its value. It's often used moving in between cryptocurrencies. XRP and BNB are other cryptocurrencies. Less important, I think, than Bitcoin and Ethereum, the two highest market cap cryptocurrencies. So here are some key features between the two. Some of this is technical. I'm not going to get into that today. Certainly not an expert in this domain. I'm talking about cryptocurrency much more as an asset class than as a technology. So key differences between Bitcoin and Ethereum. They're both mediums of exchange. However, Bitcoin has a longer legacy in that. It has more trust. So it's seen as a store of value, whereas Ethereum is much more of a platform for other things related to crypto, more blockchain, NFTs, smart contracts, often run on Ethereum and not the Bitcoin network. They provide reliability around the transactions within their networks. They just use a different algorithm there. Supply is different, infinite Ethereum, and a capped supply of 21 million Bitcoin. And then these scalability solutions, this is like the level 2, just further abstraction of the underlying crypto network for various purposes, like transaction volume and speed, for example. So when we're talking about cryptocurrency, we have to address some underlying or related technologies, which are wallets and the blockchain. So a wallet is anything that stores a private key. So if I just have a piece of paper and I just write down the private key, that's my wallet. This would be considered, for example, a cold wallet because it's not connected to the internet. Hot wallets are those which are connected to the internet, which allows for potential hackers to access them. There are a lot of examples of crypto wallets out there. Anything that stores the private key and allows for transfers can be considered a wallet. Blockchain network. So the blockchain is a network of computers, nodes on a network. It is an immutable distributed ledger. So it records all transactions that happened on the network it's a very secure system in that it's using cryptography to verify all transactions and that everything's legitimate within the network. This is what creates trust within Bitcoin and other cryptocurrencies to greater and lesser extents. So how does the retail investor use cryptocurrency? Most popular way is through Coinbase. Okay. Coinbase is to crypto what AOL was to the internet. So when the internet came around, people just had difficulty accessing it. So AOL created a way that was very simple for everyone to access the internet. And Coinbase is doing the same thing with crypto wallets. So as far as having custody of the Bitcoins, Coinbase has two different options. They can take custody of your Bitcoins and be the custodian. They can also allow you to open a wallet and then self-custody that just through their platform. And that's the service that they provide, making it seamless to buy, sell, and hold cryptocurrencies. Cold wallets can be hardware wallets, paper wallets, anything not attached to the internet, anything without Wi-Fi, Bluetooth. They're considered safer because they're not as exposed to hackers and other bad actors. So as a payment network, this is one of the use cases of Bitcoin, and I wanted to put it into perspective. This graph is an old graph, but I think Bitcoin changed quite a bit, but the others are relatively similar today. And even when this graph was made, Bitcoin was still on there, having a $289 million daily transaction value. Today it's 2.5 billion. So that puts it around the size of the American Express network. A lot of this is global. Bitcoin, unlike Visa, MasterCard, this China Union Pay, all of those are national, whereas Bitcoin is actually a global transaction network. And so the population base is just a lot higher for Bitcoin. And then transaction speed. So this is a graph comparing transaction speeds across different networks. Visa can handle a lot of transactions per second, right? 24,000 transactions per second. Bitcoin can handle 7, right? You can see on here Bitcoin Cash, which is one of those layer 2 further abstractions on the network, can handle up to 60, which better than 7 is still a far cry from Visa or other current payment networks. So thinking of cryptocurrency and having a crypto coin, what is a currency? Can this computer code be a currency? So here are some characteristics of currency, and I've color-coded them based on how much they fit with crypto. Portability, yeah, it's pretty portable if you want to. There are lots of different ways to hold and send it. Durability, yeah, for the most part, they can be destroyed, definitely, just like a dollar can. But for the most part, durable. They're not going anywhere. Divisibility, they can be broken down. You can trade a decimal of any cryptocurrency. Uniformity, they're all uniform. They're all the same. Stability, this is where crypto doesn't shine. Crypto is very variable, not stable. Acceptability, it's not accepted at, say, the grocery store, the gas station, somewhere you'll need to spend money in order to live. I'm not sure really if a cryptocurrency is fungible or not. Where they hold the same value, yes, and also they're different parts of the network, each unit being interchangeable with another. So $1 can be exchanged with another dollar, and there's nothing changed there. This is, up to debate. So yeah, totally. Let me know what you think in the comments. Limited supply. There is a limited supply of Bitcoin. Other cryptocurrencies like Ethereum, there is an infinite supply. In Bitcoin's case, yep, it fits this one. Recognizability. Bitcoin is, I think, a household name at this point. And counterfeiting is not possible with cryptocurrency. Unless it's just a fraud. That's, I think, a different case. So we all know what currency is. We all use currency, and it's an ancient thing. We exchange value between each other. Sometimes it's fiat currency, dollars, and other times it's vouching for someone. They do good work, that sort of thing. Scams. There are lots of scams out there, lots associated with Bitcoin. Related to Bitcoin in 2024, there were $9.9 billion worth of scams out there. So it's a serious problem in the Bitcoin community, crypto community generally. I've heard secondhand examples of people thinking that they were going to get rich with crypto, but really they were just putting money into a fake site. There was no backing behind it. There's no crypto behind it, but they thought that there was. Security. My biggest tip for keeping all of your accounts safe is to turn on two-factor authentication. This prevents a lot of cyber attacks, 99.9% according to Microsoft. As an investment, crypto is considered an alternative investment. So we're going to talk more about the allocation, the return, the volatility that can be expected, and the institutional activity. So, $1 million question, how much of my portfolio should crypto assets be? Unfortunately, there's not a single answer to this. It's not cut and dry like that. A portfolio allocation is based on your personal circumstance. So your current age, your goals, your time horizon for the investment, all of these will come together to determine what your personal crypto exposure should be. You can always talk it over with a financial advisor, get a second opinion about it, but this is a variable asset. There's a lot of volatility upwards. There's also a lot of volatility downwards. It's really an individual decision how much of your portfolio and net worth should be exposed to crypto. So here are some return assumptions down at the bottom of this graph here, Bitcoin as of last month. You can see that the capital gain assumptions that I'm using in my financial modeling and the volatility assumptions that I'm using, it has the most capital gains and the most volatility, which means it's either going to really work out or it's really not going to work out for the modeling that I'm doing with my clients. But yeah, and that's why as far as how much of your portfolio it should be, it's really up to who you are, your circumstances. So what have institutional players been doing with crypto? So institutional players are banks, investment brokers, fund managers, essentially companies with money. What are they doing with crypto? They're buying it, frankly. There are more and more crypto-backed ETFs every day. And so as institutional buyers buy this crypto, it's going to have effects on the market in terms of supply and demand. And yeah, institutional buyers, investors generally move markets. But they can buy today, they can sell tomorrow. Keeping an eye on what the institutional players are doing in the crypto space is always a good idea. Risks specifically to Bitcoin first, and then generally to cryptocurrency. Bitcoin has a large amount of blocks that are untraded. And some of these blocks have been lost, some are burnt and will never come back. But for the ones that have been lost and or never traded, especially from around the origination, if these blocks ever come back into the market, that would increase the supply, lower the price. So that's just a risk I see with Bitcoin specifically. Institutional backing. This is what I was talking about with the institutional buyers. They can buy and decrease the supply available, or they can sell increase the supply available and move the price around as like a bigger player in the market. So that's Bitcoin specifically. This 51% hack is something to be aware of with all cryptocurrencies and blockchain networks. If a single entity or group of entities owns more than 51% of the network, they can make significant changes to the network, which can do a lot of things. I'm not familiar with the specifics of what someone in a 51% stake position could do. However, I know that they would have a lot of power to make decisions around the network that you as a minority owner may or may not be okay with. The regulatory risk associated with cryptocurrency is pretty big. At any point, the Federal Reserve could spin up their own Fed coin, and they've done this in China. Other countries have experimented with it. This would bring a lot of the advantages of cryptocurrency to our monetary system, but also some of the downsides at the same time. It's however you feel about it, it's simply a risk that exists for this asset class uniquely. In summary, if you were to take a couple things away from this, it's not small potatoes. It's something to be looked at. It's a genuine asset class that's unique, institutionally backed at this point, so it's not going anywhere. Wallets in the blockchain are related technologies. So having a more holistic understanding of what cryptocurrency is, how wallets in the blockchain are related to your crypto holdings is a good idea. Coinbase makes access possible for everyone. There are lots of scams involving crypto to be aware of. Crypto can be part of an investment portfolio. It's up to your circumstances, who you are as an investor and your goals. And crypto has some unique investment characteristics. We went over its volatility and capital gains assumptions, and also unique risks. So certainly more on the speculative side of investing. All alternative assets are. And as a speculative asset, it requires more attention, deeper understanding, and more hands-on approach. So thank you for joining us. That's been all this month. I hope you enjoyed it. Subscribe for more and reach out anytime.